This is going to be a long-term effect that we're switching to a renter's nation. We're coming to Cincinnati. Don't worry. We'll be there.
This you guys land.
We're coming to a market near you.
What is going on, guys? Welcome to today's episode of the Collecting Keys Real Estate Investing Podcast. I'm your host, Mike DeHaan, here with my co-host, Dan Austin and Dylan Cook. And this is a real estate investing show by full-time investors and operators, made for other operators. So you guys continue to make money and do well in your business. And in case you missed that little clip at the start, Dylan is horrified that Dan and I are going to come and start taking his market share in Cincinnati, because tell you what, that market seems pretty hot. Not gonna lie. So we're gonna start promoting it here.
In the slightest.
You're scared.
You should be. What do you think, Dan? I bet 6 months we could take Dylan's whole business.
We could could crush Dylan.
Now
and then
it's a challenge.
Dylan
now
will
I
be
want
paying
you guys
us.
to come here.
Wait, dude. What we'll do is we'll put Cody over there in an Airbnb for like 6 months, and he will just carve out his own little like niche of these like weird ass deals that nobody else can seem to get done, and it's just gonna chip away at your bottom
So that's
line.
I feel like those are the deals I do. So like,
see, exactly. That's what I'm
We're gonna
saying.
steal your shit from you, dude. Just out of spite, for no good reason. We're gonna just donate all the
after I
profits.
give you guys appraisers, lending contacts, or like all
you
this
have
stuff.
been nice to us.
It's called espionage. It's what Russia has been doing forever, right? We're basically the same thing, but
It's true.
I was saying this right before we started. I looked at buying some stuff back in Cincinnati back in 2019 when I was selling off some of my single families that I appreciate. It was actually like my old primary that I bought in 2015 that I kept as a rental, and I was planning to roll into like more stuff. And I ended up going to Minneapolis instead of Cincinnati because the cash flow was better, and that was what I cared about back then. But I definitely messed up because Cincinnati has boomed. And Cincinnati also doesn't have all the shitty weather that Minneapolis has. But, I don't know.
Rained like, I feel like 2 weeks straight right here right now. But
Really?
Welcome
to Washington.
Yeah, right. But does it have minus 40 degrees cold snaps with fucking windstorms? Probably not.
Yeah.
I mean, not right now. No.
Not right now. But no.
Are you rental free now, Mike?
No. I got all this
okay.
shit that I sold with Dan, and then I got a triplex and duplex still, which will be on the market. Now that I've sold all my single families, and honestly, without those, I'm like, I'm not as heavily motivated because I do have a ton of equity in the multis, but they do actually cash flow okay,
Right.
and they're stable, they're relatively easy. And my plan is, if I don't get the price that I want, kind of by like the end of the summer, that I'll probably just look to get like a line of credit. And I did the quick math. I should be able to pull out about $300,000 on credit out of those. So I would still be leaving in like 300, but I would, get a good amount of liquidity that I could go do loans. I haven't paid taxes.
Yeah, you lend it and arbitrage difference.
Yeah. So
Makes
that's
sense.
kind of my strategy with it. But Dan and I still own a bunch of stuff, which we're trying to get rid of the single family, the less cash flowy stuff. But even then, like the multifamilies that Dan and I have practically rebuilt are all pretty strong.
Yeah.
So,
I mean, I've added close to like 40 doors in the past 2 years, but like it was the beginning of 2023 or 2023. I'm like, I'm not buying single families anymore for that same reason. Like it has to be a duplex or larger for me to consider to hold it.
Yeah. I mean, the perks of the single families, they're easy to sell, right?
Yep.
When you don't want them, and they're easy to force appreciation, but the cash flow piece is kind of the trade-off. But I mean, tell you what though, like all the single families, when I listed them, I don't think a single one was on the market for more than a week.
Yeah.
They all
That's
just
kind of
flew.
like, we talk about on the show a lot, the affordability, like a lot of the economic indicators aren't necessarily good right now. But like what we're feeling with boots on the ground, and maybe it's, Spokane and here I am, is we're kind of going like firing on all cylinders still.
Yeah.
And
there's an argument that maybe like the Fed did like a good job and everything's just fine.
I don't know if I can admit that.
No, well, I don't.
There's an argument for it because it's like, why are you like, first of all, like all the economic indicators always point to something different. People are like, oh, I'm so surprised by this happening. It's because it's like all happening in real time. You don't really know what's going on, but then you can look back and you can like say, hey, actually, it wasn't like all that bad compared to what people were saying, because it's always the sky is falling. It's just human nature.
I mean, I don't know. Like, it depends on what media you consume, right? Like, if you look at the actual macroeconomics, things are very, very poor. I would say
Are they though? What's poor about them?
the general affordability of
what?
everyone, of people who are like
Yeah.
can afford just standard goods.
Is there blood in the streets?
Not yet. The consumer debt is massive.
Yeah.
Right.
But
So
what does that mean in real time though?
The thing is, like, everyone's like the wall is cracking, right? And but every now we're still able to do deals. So the thing is, you're not caught if that dam breaks, right? That's what everyone's trying to avoid.
Yeah.
And unfortunately, I don't know if anyone has the answer of when that's going to be.
Correct.
Yeah. When could it be 20 years from now? I guess that's my point. That's my point in saying all this is like, you know, we know the foundation's cracking. Like, if you look at it, like from a debt standpoint for the U.S. government, like, man, they're like Moody downgrade, like nobody's going to want to buy our debt. It's going to get really bad, but it's like when? And if you think it's going to get really bad now, then you're going to make certain decisions. But if it's 20 or 30 years from now, the decisions you're making today, probably if you're doing it defensively, probably aren't going to help you.
Sure. Yeah. But I mean, yeah, it's one of those things, like, it's, in hindsight, everything's 2020 and stuff does take a long time. I don't think a lot of people realize that. And I always think it's funny when people quote history or like historical things, you know, that have happened, and they equate the trends to exactly what's going on in like the modern world, because
some previous economic situation that doesn't exist anymore.
Well, not only doesn't exist, but the previous economic situation I talk about took 20 years to happen. Right. Or like, you know, people always talk about the authoritarian sort of set up in, you know, World War II and those sort of things. People don't realize that it took, like, you know, the Nazis in World War II, like close to a decade to go through that whole process. But when you learn about it in history class in a 3-day segment, it feels like it's very, very fast.
Yeah.
You know, and so same with like economic collapses, you know, those things tend to take a long time. And even like if you go look at the Depression, sure, there was a Black Tuesday or whatever the big day was where the market collapsed. That was a singular day, but there was so many things up to that led to that first. And then the real issues came over the following close to a decade afterwards, where things were really bad. So,
I guess the only thing I'd like to add to that is there are recessions and whatnot that come without some dramatic event. Like, you can gradually go into these. So it doesn't have to be a Black Tuesday or a Lehman Brothers event in 2008 or a COVID of, you know, March 2020 that these things kind of happen. They can just be gradual things.
Yeah. It's like that with everything, right? Even look at, you know, outside of economics, like your health. You typically don't immediately have a health problem. Health problems that they develop over years and decades, the vast majority of the time.
Yep.
You know, but we will just let them go unchecked. And so when you have trends that are negative, when you walk around with high blood pressure and, you know, poorly regulated blood sugar all the time, eventually that's going to lead to health issues. And so if you look at this with like the economic standpoint, when you have a massive consumer debt issue, you have defaulting on loans, you have the treasury continuing to climb, and you just have a general unaffordability for most people, it's safe to say that probably will lead to problems at some time in the future. You just don't know exactly.
Keep this in mind. So like 2008, 2009, like worst modern day financial crisis we've ever experienced, right? And many people were affected, but like, I don't know, people were still making money. People in our shoes were still doing well. People were still buying and selling houses during the worst economic crisis.
Of course.
And so then also, kind of as we come out of that, they created monetary tools that did not exist before that. So who's to say we can't create some genius smart person in, you know, either in like the FOMC or somebody, you know, some smart economic person is going to create a new tool that's not quantitative easing or quantitative tightening, has nothing to do with that they can help kind of build out and actually create what would have or avoid like a modern day disaster, right? Because all the economic indicators are pointing towards like a major crisis if you're like a person that thinks it's going to happen that way. But what if it's more of like a soft kind of, like you said, easing into it and easing out of it? Is that not an option?
I'd say it's a low probability. And like the acronym department at the Fed's going to be busy, right? Because they always come out with these things. There's quantitative easing. They have the SLR ratio requirements that are just like the leverage ratios that banks have, that they have to hold treasuries. Like during COVID, they got rid of that. So they could provide more liquidity, and then they brought them back. But they'll probably get rid of that again.
Right.
I think to the point is like, the saying is history rhymes, or history doesn't repeat, but it often rhymes. And so I don't think there's a way, if you just look at Mike's point, the affordability and prices, either wages have to come up or prices have to come down, one way or the other. And so can that be gradual and slow? Yes, but this is probably not the most likely scenario I put my money on.
Yeah, I think that the challenge we're in is like this lock where you can't drop rates, which is what they want to do, right? At least the Trump administration, because I probably would assume that there's still some level of inflation shaking through the system, and there's enough demand, I think, right now for things that it would cause additional inflation, which would just kind of keep repeating the cycle of like a death spiral.
It's a feedback loop. And plus the 90-day tariff stuff is like that 90 days will come up soon, and who knows what's going to happen when that time comes.
Right. So they're going to kick it down the road.
They kick the can, as they always
do.
don't
be dumb. Like Trump's going to do whatever's in the best interest of his like election and what he looks like, and he's an economy guy. He's not going to want a bad economy. So if the tariffs, he also has like really, really smart like people on his side on the finance side that I actually like do respect, that I think are really good, that are telling him what to do.
Well, Scott Bessent was like the Treasury Secretary or whatever.
Yeah.
And he worked with George Soros when he was younger, which they famously, they call it, broke the English pound and basically like devalued currency. And this was a long time ago. But point being is like the dude has the contacts and the knowledge base to seemingly go through any kind of economic environment.
And he's likely going to be the next Fed chair. Like he's a legit player. And I think that if Trump's smart, he's listening to him. And so I do think that anything like the black swan stuff with tariffs is not actually going to ever result in anything.
I guess my whole point in all this is like, you talked about Spokane firing all cylinders, kind of doing here in Cincinnati. It's like, I almost feel a little insulated being in this market, and maybe that's right or wrong. I don't know, but that's how I feel right now. So I'm still very aggressively like doing this business and even taking down more stuff right now. And time will tell if that's right or not.
Well, and I think that that's the direction these are going to go. So I did a little talk to John Brooks's brokerage, who was on the show with us last week. I did that talk today, and kind of talking about like wholesaling and marketing and things like that. But one of the discussions that came up was around just like the general economy and where we think real estate and stuff's headed. And so Jacksonville, where he's based right now, is currently in the worst housing market in terms of inventory increase and time on market and just general lack of sales that it's ever been in. It's significantly worse right now than it was in 2008, and it is trending worse at a very aggressive rate. That's just one market that I know of because I know somebody there. I'm sure there are other markets that are similar. Like I have friends that are doing stuff in Austin. One of my good buddies is one of the biggest house flippers in Austin, and they can't like give a house away right now, right? Because of these markets that have had these huge run up. And I guarantee you that there are all these busting markets that are going very, very sideways. But then the places where, you know, things are going pretty well, I don't think we're going to necessarily see that. Like, I don't think it's going to be a national sort of wave that causes issues, because I know, for example, in Washington State, and I imagine Cincinnati is similar because I know people have been moving there for a while, there's a good desirability for cost of living. There is a younger population that has been moving up here. There's generally like a higher income compared to the national average. I don't know what Ohio as a whole state looks like, but I think Cincinnati would fit into that.
I would agree.
And so people can generally just like afford to live life at like a basic standard that they enjoy. And it's also like a good place to live.
Right.
You know, like even if people are like generally poor, people move to Washington because it's sweet. Like it's a beautiful place. It has good services for people that are not making a lot of money. Like there's a ton of stuff to do. It has great school systems. Like it's honestly what you should be doing is betting on places that from like a social factor more so than just like a total economic factor, in my opinion.
Right. Especially a place like Washington, because there's this argument that I guess a place that has more social services is better for a younger generation than an older generation. So you won't see old people moving to Washington because they don't want to have to deal with the benefits of the younger getting, whether that's, you know, taxes or whatever it is. And that's why you see a lot of people moving to no income state.
Or, you know,
states, like so no income tax
being
states.
Gay, old people hate that shit.
They hate it.
They definitely don't want to come to Washington.
You can do that openly here.
Yeah, totally.
But I think to add on to what you're saying, Dylan, with the insulation, I think you go back to like the local economics of what we were taught. At least I remember learning when I was going into real estate. It's like, look at your local economy. And in Spokane, we didn't get crushed by 2008. We felt it. I think everywhere felt it somewhat, but like we weren't like, it wasn't that bad, but it was not good. But if you just go and like look up your largest employers in your local market, you'll start seeing, and then you can look at the macroeconomics of who in what industries are being affected. So like for us, like largest employer, Fairchild Air Force Base, then you have teachers, then you have hospitals and medical folks, right? We don't have any single major employer. All three of those are somewhat government funded, so we're quite insulated from things. And then we have some pretty large, like mid-size, large for our local companies, like a handful of them, and then the rest of them are like honestly just like small companies. So we're pretty well diversified and insulated from like a major economic thing where, for example, if you're over in Seattle, although I'm just using this as an example, but if there's a tech bubble, there'd be blood in the streets, because all of that, like they're major employers that are also concentrated with wealth. Those employees are all like Microsoft, Google's, Amazon's, Starbucks, all that stuff. And so like, I don't think we're at all going to see that bubble pop, but like Austin, like if there was some tech struggles, I think those companies would certainly feel it. And then because the market ran up so much, a lot of those people were going to Austin, but working remotely to places like Seattle. And I would also add that I think the Florida situation is more unique than any other boom bust market they've experienced in the past, because Florida, Arizona, these states like that are known for like the boom bust cycles. They feel it the worst. But with COVID, there's the black swan event with COVID, which was, I'm going to move to Florida because of political reasoning, as well as like some sort of freedom. Like I didn't want to wear a mask, or I didn't want to do things. But you also had all these people bouncing over to Austin and bouncing over to Florida for reasons that had nothing to do with economics. And so you had an even higher boom market. So I think the trough compared to the peak is going to be way deeper. And I think there's no way they're getting around it.
Well, and then you have like everyone in real estate probably has like the recency bias with 2007, 2008 being the last like true recession that we had. But that was more of like a nationwide thing because it was a real estate related recession,
right?
Because like the ninja loans that they were doing, no income, no job, no assets. Here's your $500,000 loan. And here's
every market.
Yeah. And that was everywhere. And so like, if that's going to happen in today, I just don't know what the primary driver is outside of affordability. And so prices have to come down in some way, but like real estate's probably the biggest like chunk of someone's expenses.
Yeah.
Prices have to come down or the buyers have to change.
Yep.
Right. And so like, I think this is a big reason in the lending space with our lending business, we're starting to see such a push for DSCR loans, and DSCR loans actually trending to rates lower than conventional loans. Right.
I think not to interrupt you, Mike, but I think that needs to be like replayed, because I don't think people know that unless you're a lender right now.
No, it's a really weird phenomenon. Because like I remember getting my first DSCR loans, you're kind of looking at it back in like 2018, and they were always like significantly higher.
Super expensive.
Like we'd be looking at 8-9% interest, you know, and then a conventional mortgage would be like 5.5%, 6%. Now we're getting to the point where, so like in your notes here with the 10-year treasury increase, they're saying mortgage rates will be back above 7%. We're able to write DSCR loans in the 6s right now if it's a good deal. Right. And so what that means is fundamentally like the big money, the ones who buy these tranches of mortgages, they are looking at investor grade debt as being more favorable than consumer grade debt. And I think a lot of that is due to the, unperforming like borrowers and people that have debt that are on the consumer side, right?
Totally.
Like would you take a 96.5% levered FHA buyer, you have to pay a $40 credit card so you can apply, or an investor with a couple $1 million of equity at $300,000 in the bank.
Absolutely. But the funny thing is, it's not like any investor, right? Because we've also seen it really tighten on what they're asking for their underwriting. So they're not doing like rural properties, right? They're wanting higher credit for investors. They're wanting to have like more months of runway and better financial stability. So basically what they're doing is what any smart person should do is they want to bet on the people that have money and a track record. And they're kind of moving away from like the everyone else group, right? Which is the vast majority of the population. And so what'll happen is more people with money will start to buy the houses, and they will continue to sort of like be able to make that investment work for some reason or another. Because the other thing too is the government will be incentivized to make sure that people are providing housing and are buying houses, right? Whether that comes in the form of like tax deficits. Florida or some of these places are talking about getting rid of property taxes, which will increase the cash flow in all these places, because rental rates can only go up so far
Yep.
Like they're going to change something on that end. 40-year mortgage. Like I've already heard about 40-year DSCRs.
Wow.
Right.
So
Which
do
will make the
you see this
payment
trend
lower?
continuing of like more competitive investing lending?
Totally. I don't know how it won't.
That's what's like intriguing to me is like I worry like not worry but like I think about this. Is this like a blip in time? Because I think capital markets are efficient, right? Like they will find the best way to deploy capital in the most secure way in times of, it's like going back to recessions. People make money during recessions, right? But like, or is this a long-term, this is going to be a long-term effect that we're switching to a renter's nation? Because it goes back to that affordability issue. Like, I don't disagree. There is a major affordability issue when it comes to housing for most Americans. And it only continues to, as generations hold on to their housing, we all become house dragons and we have low interest rates that are locked in for the next 30 years. People just are less incentivized to sell their house unless they have a life event. And people are more likely these days to say, well, I'm going to hang on to that house as I step up into my other house. And I talk to so many people that are not real estate investors. They're like, well, we're just going to keep that one and rent it out. Right. And so are we actually switching over now over the next 20 to 30 years to a renter's nation because of the affordability issue? And I'm not saying that that's a bad thing. I think people are going to have to develop wealth a different way and not in their primary home now. And because I will say owning a primary home like does kind of suck sometimes.
No,
like
yeah.
When you have to repair it, when your taxes jump up, when all that stuff jumps up, rents at least lag that.
Yeah. I saw something the other day, like the median age for a home buyer is like 50 something right now.
That's crazy.
But that was the same age for someone like 2007. Like basically there's like 20 years apart and the median age hasn't changed.
Right.
Yep.
Right.
So
is it during that time?
Trading houses amongst each other's.
Yeah.
Gotcha. Okay. Yeah,
no, so basically I saw
it went from like 38 to 50.
I think that was actually John Brooks that shared that on his Instagram.
Really?
And so it said, the average age of the average birth year of a home buyer in 2008 was like 1967, and then like the average birth year of one in like right now was like 1969.
Yeah, that's what
they were fundamentally the same like bracket of people.
They're the only people actually transacting houses right now.
Correct.
Right.
Yeah.
I see. Yeah, which makes sense because they're the ones with wealth, and they're also the ones that need to downsize, or at that time, up in time, maybe buying a lake house 20 years ago.
Totally. Yeah. So I don't know. Like on this note, when I did speak to John Brooks's group today, he actually asked a question that I thought was pretty interesting. And so I talked a lot about when Dan and I got started back in kind of 2019, 2020. And COVID happened and a lot of our competition left. Dan and I were able to kind of take a good market share because of that. So John Brooks's question was, okay, so now we're in a similar situation where there's a ton of real estate people that are leaving the market. What would you say is like a good tip for someone to have the mindset to keep basically charging into the fire when everyone else is running out? Okay. So what would your guys' thoughts be on that?
I'll think about it for a minute, but it's when you're just starting in that position, you don't know what you don't know. So you kind of just go for it out of ignorance. Dan, you got an answer?
Here's what I would say as somebody who's like, I lived like as an adult and like somebody like somewhat investing or being invested through like 2008, 2009. Like I fully experienced that. Going into COVID, I experienced that. There's tons of uncertainty in 2008, 2009. Tons of uncertainty during COVID. There's tons of uncertainty right now. Like uncertainty is like the only thing that's guaranteed in any business in any industry. And going into real estate now, it doesn't feel like it's the right move. But if it's something that you are looking like, that's where you're going to plant your flag. You plant your flag in any industry, but if you're going to plant your flag in real estate, what a better time to do it when A, it's hard and you have to learn the hard way, makes the easier times even better. And B, there's just less competition. 71% of real estate agents last year didn't sell a single house.
That's funny. It's
so just because there's a ton of, you know what I mean? Just because there's a ton of real estate agents out there doesn't mean that they're even your competition. There's a lot of people parking their license. There's a lot of people like me who maybe sell a handful of your own listings once in a while. Like don't like let what you think is the competition affect how you're going to make your business decisions. Because as we all three sit here, I agree. Like it's kind of like a very uncertain time, and I don't know what's going to happen tomorrow. but I could still guarantee that I'll make money tomorrow in this industry. And as people jump ship because they suck at being business owners, you can still dig your heels in and make quite a bit of money.
Yeah. What my response to it was back then when we started, what we really focused on was doing the things that other people were doing that was getting them results. Right. And we just figured if we did the same thing, then we would also get results. And sure enough, it worked. I will say for me personally, the main difference between now and then is back in 2020, it was COVID was the big hiccup. That was like a biological event. And I was like, well, it's eventually going to go away. We're all going to
it's like a flu, right?
Yeah. Well, that's the thing is like when you have like a
know.
disease, there's eventually going to be an end to that. When it comes to like a larger, political, like macroeconomic issue, it's kind of harder to see that because very seriously, you could have a macroeconomic situation that goes on for 20 years. Right. Sure. Like the fact that COVID even went on for 2 years blew everyone's mind. Right. But we knew that wasn't going to go on for 20. And so it was a little bit easier to see past that. Now, I mean, I think just look at who is currently making money and literally just copy and paste what they're doing. Right. Yeah. And then you're not going to do it as well as them, but that's where the skill set comes in.
Can I add a caveat to that before Dylan answers?
Sure.
Do your fucking homework though on who's making money, because as we've seen, most people out there are not actually making money. All the gurus that are literally just, I mean, you could open up your Instagram app and every single day there's a new guru story about them just ripping people off and not making any money. So I would say on that, do your due diligence and find people that are just genuinely like honest and like just doing their thing. Mm-hmm. That's it. That's all I do. Yeah.
Yeah. I don't have much to add other than like the influencer people is probably not the people to go out. Find the guy that's dressed in like freaking overalls at your local Home Depot and drive the
totally
beat down truck.
Honestly, do what our interns that work for us have done, where they know that we're making money and they say, hey, can I like come and work for you and like learn from you? Yep. Right. And yeah, they're in there every day. They're doing the hard work. They're doing the shit that we don't want to do, but they're also going to be around success and they're learning. Yep. And if you're like a 40-year-old dude and you're like, I don't want to do that, I'm a fucking banker. It's like, well, then you don't want to grow a business that badly.
Yeah. Right. I have a question for you guys that's kind of related to this, but I got asked this question earlier today. Basically, and the gist of it is, would you ever or could you ever take your current wholesaling and real off-market business and hire yourselves out, like basically hire a CEO, and now you're strictly the owner, where you're spending less than 10 hours or less per week on this?
We pretty much
making the same amount of money.
We pretty much did that last year with our like big backyard home buyers crew. Because we had the whole team over there, right? We had this guy, Matt, who basically ran the team and then did dispo. And then we had outsourced a lot of the disposition to the partners in those markets. Like, I mean, there was periods of time where I didn't have any idea what was going on in the pipeline.
You can't do that. I think the incentives, you got to inline the incentives, right?
Totally.
And you got to find the right person. I think the profit share employee is probably the best, or some employee that's highly incentivized transactionally.
Yeah. I guess I have not heard, I mean, you guys may be the exception with your national brand, but like, especially locally, I've not heard of that being a thing. And I just had my brain turning, I guess, if I paid someone on 150K a year to basically be the CEO of my business and how that would look like. But then what else would I do, right? I don't know.
Yeah. You'd find something.
Yeah. Well, what happens? You get into fucking making content and having a stupid podcast.
Yeah.
Like that's what happens when you have too much time.
Start a private lending company. I don't know, whatever.
Yeah.
So
that's like the number one like red flag when I know people are either crushing it. I'll say red flag. No one in here, I know people are either crushing it or going very poorly, is all of a sudden they become a YouTuber.
They've become a YouTuber,
dude, totally. Like there's, absolutely. I mean, guilty myself as well. Like we got a point, I was like, I guess I don't know what to do. Like we're making houses. I would have sales calls with people, like looking to bring more partners or with scale or doing different things. But we were doing a lot of transactions. And then I went and did content and I was like, this is fucking horrible. And so I did shitty content for years. And now I'm back to being in real estate again, and it's way better. Like I prefer that.
Totally.
But you could do it. I think the biggest thing is if you're trying to grow a business, where like the mindset shift that you kind of have to happen is your profit percentage will take a significant dip.
Oh, for sure.
Yeah.
Right. Yeah. You're no longer running a 70% profit wholesaling business. You're going to be down at like a 30-40% profit wholesaling business, more like what every other business is, right? Yep. Like wholesaling is kind of an anomaly in the ROI you can get on it as like a relatively small business. But a lot of that is because we have the ability to have the same cost of lead indicators, right? Same cost per lead, cost per deal, but hit home runs on those. Whereas like most businesses don't have that.
Totally.
So, but
Makes sense.
you could do it. It's just different.
Yeah, I think you could, and I think you just you have to have a different expectation for what that business looks like, because it might not actually look like the solopreneur business.
Yeah.
And
there's no way it would.
No, I mean, as far as how you operate, like it has to be different. Like I know on the last podcast, I think Mike, you mentioned like maybe New Western, although we all hate them, might be the only like nationally recognized, technically wholesale business that is sellable. And there's a big question about people like, well, if I can build this business, can I sell it? And I heard this it wasn't Alex Hormozi quote, but he quoted somebody else saying, if your business isn't growing, it's dying, kind of thing. If your business isn't growing, it's worthless.
Yeah.
Meaning that it's not worth anything because there's no growth, or there's no growth potential. When you look at how companies trade, technically speaking, it would be off a multiple of income. And if your income's not growing, well, technically you aren't actually growing because you're losing profit to inflation every year. It's just an interesting way to look at it. But in this business, like going after growth is almost unsustainable. So you get to a spot where maybe you're making, top line $1 million a year, taking home 250, 300, you're picking up a few rentals. That's pretty freaking good. Do you want to change that? And if you do, then you probably need to double that to doing $2 million in revenue, having a key employee that's making 150 to 200. But now you have an asset that you probably could sell if you're into that kind of thing. But you're also getting kind of that, you're getting that owner share and maybe doing 10 hours a week, to your point, Dylan.
Yeah. And I would say the trade-off to the fact that you can't hit home runs in this business is that there's also more room for people to be less efficient, right? Because you can't just directly control the return on ad spend quite as easily. So like going to your point on the notes that you put in for the recording, Dylan, about how, your realization that you're doing more deals right now because you hired an AM, but now your fees are lower.
Yep.
Right. This happens to everybody because so you said you went from 18,000 a deal to 8,000 a deal, but you are like doing more of them. And I don't think that there's I can't think of like a good way around that, because the problem is you're now kind of like not fully like in line, like your goals for you versus the AM are like slightly different.
Well, his is to get the contract, and mine is to get the steepest discount I can get.
Exactly. And so if it comes down to him, the option is getting no money versus getting some money. He's going to get some money all the time.
Yep.
And having been like a sales rep in a company before, I totally understand that. It's like
I'm not mad at him for this. It's just a realization that I'm having.
Yep.
Yeah. And that happens with every level of individual that you add to the business. If you go and add a dispo manager, the exact same thing is going to happen again. All of a sudden, instead of making $8K, you're going to make $6K a deal.
We literally just closed on one yesterday where my net proceeds after I pay him will be like $3,000.
Nice.
I'm like,
that sucks.
I'm like, this isn't even worth it, but it is, because now he's happier. He's going to do more deals. Like,
he's getting paid the same, and so he's happy to get that thing out. I'm assuming he's getting paid the same, but
yeah, he is.
Yeah. So and that happens in every business, right? With every level of new individual that's involved, you have some inefficiency that happens. Especially on sales. The only way to get around that is if you have like super hard like rules around, what your auction look like and underwriting, everything else. But the problem is with that is real estate's extremely subjective. Values are going to vary. Like 5 people can look at the same property and have a different offer price they're going to pay for it.
And I used to like look at all these properties myself before we'd offer them. And so there's a little bit more retrading now that I like to do, because it's just learning curves along the way.
Yeah.
That's part of this.
Yeah. I mean, like, that's a huge part of it, but also too on the same note, what'll kind of ultimately start to happen is like this kind of business, especially because it is really small, is if your expectations are kind of unrealistic, right? Or you're constantly trying to need to get like, I need to make $30,000 per deal, because you're a 2 or 3 person business. Eventually the guys are like, I'm going to go make my own fucking $30,000.
Yeah.
Right. Like there's no actual like IP that protects the business. Like he could just go and sign the contract himself with the seller and go and dispo it if he wanted to, And so it creates this funny dynamic that I think is really hard to get out of.
I would cap it off also, or by adding, how long have you been in this business before you hired? Like 2 years, like actual, like running your own business?
Yeah, it was close to like 20 months. essentially.
20 months, and you'd have been in real estate a little bit before that and all that stuff. And so like you wouldn't go start a hardware store or a restaurant and be like, yeah, man, I've been in it a year. I've hired out all the things and I'm just like a owner operator or an owner that just doesn't have to do any operations. Like, so, but for some reason in real estate, I don't know what it is, but we get our heads wrapped around this timeline needed to be faster where you think you can exit your business early and just have people run it for you. It's like, that's not how it works in any business. Like, especially if you're starting it from scratch, like from literally zero. If you went and opened a restaurant from zero, I guarantee you any of these restaurateurs here would be like, yeah, I work 24 hours a day for like 5 years. You know what I mean? To get to a point to where they maybe don't have to work every day. And so
a couple of years ago, there was a We Buy Houses franchise. They're trying to sell like the biz buy sell for like $50K. I don't think it ever ended up selling either. So
But, well, Dan, I know you haven't been hanging around with the buy business crowd too much because they would completely argue against you.
I know. I'm sorry. Well, I'm just going to buy it and I'm going to put an operator in place and I'm going to make like $500,000 a year.
Yeah,
exactly.
Well, there's abundance guys that proves that's not the case.
I know. Right?
That was the ass.
They're like, I'm going to use AI to build the business plan. I'm going to hire some VAs to basically do it. I'm going to hire an operator on the ground, pay them $37,000 a year. They're going to have a lot of joy working for me as a slave.
They're going to love it.
Make sure they fill out the culture index first.
Exactly. Can you please do my DISC assessment for my $40,000 a year job?
Yeah. Oh man, I was just at we can actually. This is a good thing to maybe tie it off after that. Is the Go Abundance. I'm not a champion, but I was at a champions event on Wednesday and Thursday, and so there's a lot of high net worth people there. And I realized at that event that my problems are a lot smaller than some of these other guys' problems.
Oh yeah.
Yeah. One guy, like his business partner basically went psycho and took $3 million out of the business bank account, his own personal account.
Hell yeah.
And like he has to like sell his rentals to keep the business going, and they're gonna have to go to arbitration and like all this kind of stuff. I'm like, oh my God, that sounds freaking terrible.
That's wild,
and that was just one. There's many more, but I won't come to that.
Yeah. I mean, their business does not come without problems. I can't tell you the last time that I met a business owner that was like, everything is perfect. It literally never happens, but the thing is like the speed bumps do make all the good stories, right? And that is where growth ultimately happens.
Totally.
Even like the biggest, most like experienced business owners out there will always have something that happens. And because that's what happens when you're, kind of paving the way. And the funny thing is, if you're an employee, whatever company you work for still has that same shit. You just don't see it.
You don't see it exactly.
You're in the hole, right? In fact, you probably are the speed bump.
You're creating the hole.
You're the one is the problem.
You're there. Like every day your boss gets in his office and goes, fuck, I should fire Craig today.
Oh shit.
He's like he's so fucking annoying. I do not want to be here.
Yeah. That's true. Yeah.
So, but anyways, cool guys. Anything else to round out?
I think I'm good.
Sweet. All right, everyone. Well, thanks for tuning in with us today. You guys have a great rest of your week. We will not have a Friday Focus this week, so sorry everybody. We wrapped that up. Last week was my last one. So if you guys want to check that out, I did do a little breakdown of my my third session at acquisition.com with Alex Mosey's crew. People liked it. I actually got like a shocking amount of outreach on my Instagram from that one. So go give it a listen. It'll be our last Friday Focus that we do for a little bit. Maybe we'll bring it together sometime in the future. But for right now, man, we're just trying to make some more money with real estate because like we were talking about during the show, I think that's where a lot of the opportunity is right now. So cool. Keep building, everybody, and we'll talk to you guys next week.